In this recording, we're going to discuss the income statement, or sometimes called the profit and loss statement. It's really your report card for your business. The income statement shows the performance of your business for a specific period of time. So often we look back over the last 12 months and say, how did the business do? It determines the profitability of your business. So an important document, really like your report card. You look back, you look at the revenue, you look at the cost of sales, you look at the expenses that you incurred over a period of time, and most importantly, did you generate profit? So the income statement tells you about the profitability of the business. It has the revenue, it has the cost of sales, it has the gross profit, it has all the expenses you incurred for a specific period of time. It shows you the net profit, and importantly, it shows you exactly how much income taxes you're going to pay. So an important document that I would encourage you discuss with your accountant at the end of every financial year, because it tells you so much about the business. So what I'm going to do here is show you a little example of an income statement. I'm going to create a very simple one that would reflect a business at the end of the year. So let's use an example. Let's say this is a business that did $150,000 last year, and I'm rounding off the numbers just because it makes it easier for me. And let's say it was a service business, and what they do is they sell content. So they have writers and producers out there that create content for them, and they resell it. So let's say their cost of sales, in this case, because they were a service business, were quite low, say $30,000, giving them a gross profit of $120,000. Revenue, $150,000. Cost of sales, $30,000, giving you a profit of $120,000. Let's say last year, this business spent $6,000 on sales, on advertising. Let's say its accounting fees were $2,500, okay, to do the financial statements for the year and to make sure that everything's up to date. Let's say this business paid $18,000 in rent. Its telephone was $1,200. It had employee salaries of $24,000. The owner didn't take too much this year. Let's say the owner took a salary of $18,000. Let's say insurance was $1,200. Let's say stationery was $600. And let's say repairs and maintenance was $2,400. Now, these numbers are just estimates that I put in here, but obviously you understand, or hopefully you understand, that your accountant would take your actual numbers and input it into this document. So that's the way they would do it. Let's say you had some assets that you purchased at the beginning of the year before you started this business, and let's say the depreciation was $12,000. Let's say you took out a bank loan and the interest for the year was $6,000, and those are the numbers we input. I'm not going to put in any more numbers there. So let's look at how this business performed last year. It did a revenue of $150,000. It had a cost of sales, or its inputs, of $30,000, giving it a gross profit of $120,000. Advertising was $6,000. Accounting fees were $2,500. Rental for the premises, $18,000. The telephone was $1,200. Employee salaries, $24,000. Owner's salary, $18,000. Insurance, $1,200. Stationery, $600. And repairs and maintenance, $2,400. Now, obviously, if this was your business, you'd have more line items in there. I just put in just a few just to show you what the income statement is. And this tells you that this business made a profit of $28,000 before any taxes that it pays. Okay? Then you deduct the taxes off there, and really depends on what business you're operating in. If you're incorporated or if you're a sole proprietor, what this number will be. Okay? Let's assume that you paid 15% because you incorporated. It'll give you earnings after tax of $23,885. And this is a document you would discuss with your accountant. And let me tell you why you would discuss it with your accountant. Because there are a lot of things that you can do to improve the profitability in your business. So let's start at the beginning. On the right-hand side, you'll notice that there's some percentages here. And these percentages are calculated by taking your gross profit, in this case, of $120,000 and dividing by the revenue. This ratio over here on the right-hand side is calculated by taking your advertising of $6,000 and dividing by your revenue. So these percentages are what we call ratios or benchmarks, and they're very important for you to analyze. And I encourage you to sit down with your accountant or your bookkeeper and analyze these. So let's look at the first one. So the gross profit margin in this case is 80%. Now, what you do as a business owner, you would compare this 80% to last year to see if it either went up or it went down. So that's one of the things you can do. You can compare yourself to other people or other businesses in similar industries, which makes the income statement very, very relevant for you as a business owner, because now you can make comparisons. So when people say, how are you doing? Well, if you compare yourself to other people in the industry or to previous years, this will give you a really accurate number that you can use to determine how well you're doing. When it comes to this business, their advertising is 4% of their revenue. Okay, so there's their revenue. Divide this number by that number, and you get 4%. So 4% of their revenue is spent on advertising. Is this good or bad? Well, again, it depends on the industry, depends on industry averages, depends on previous year's numbers. So this will tell you a lot about your advertising. It will tell you whether your advertising is effective or not. So a really important document for you to analyze. I encourage you as a business owner that you sit down with your accountant at the end of every financial year and go through these percentages. And by looking at these percentages, you can determine how well your business is doing. So let's look at rental. Rental is 12% of revenue. Is that high? Well, it depends on the industry. So you would make comparisons against other people in the industry and determine if you're paying a fair rental. Employee salaries is something else you could measure. So you could measure all of these ratios, and it'll tell you what you need to do to improve your business. So this is what I like about these percentages. They give you information. So if your accountant hasn't done this with you yet, I encourage you to sit down with your accountant, make an appointment, and discuss your previous financial statements. Ask them to calculate these ratios for you and discuss them so that you can improve the way you manage your business. For those of you that are in the startup stage, you need to produce a projected income statement for your business plan. So understand the importance of doing estimates of what your revenue and expenses are going to be over the next 12 months. This is a really useful document. I encourage you to discuss it with your accountant. It's going to make you a better business owner. So get out there and discuss this with your accountant and improve the way you run your business. Now, here's some tips for you. As I mentioned earlier on, discuss your income statement with your accountant every year. Compare your gross profit to industry averages, okay? So you look at industry averages and see how we're doing. Also, compare your gross profit to previous year. So how are we doing relative to last year and the previous year? If we notice that our gross profit percentage is coming down, well, we can do something about it. We can go out and renegotiate our input costs with our suppliers, or we can maybe just manage it more effectively. We may have a problem of wastage, or maybe you might even identify that you have theft in your business. So the income statement will help you determine this. Compare your expense ratios to industry averages. Remember those percentages I was discussing? I encourage you to sit down with your accountant and compare them to industry averages and compare them to previous years, because that'll tell you how you're doing. Develop a strategy to improve your income statement. So increase your revenue, increase your gross profit, increase your net profit, reduce your cost of sales and your operating expenses. These are things that you can do as a business owner, and they're going to make you a more effective business owner. So understand that this is going to help you improve your business and hopefully make you a more profitable business. So you've got to be sitting down with your accountant. If you have any questions about your income statement or your profit and loss statement, I encourage you to make an appointment with your small business consultant at Enterprise Toronto. They will help guide you through the process, or they'll refer you to somebody that can help you with your income statement. This is an important document you should be discussing with your accountant once a year, because this is going to make you a better business owner.